What if I told you that the biggest threat to the global economy in 2025 ISNT inflation isn't rising interest rates? It's something far quieter, something buried deep inside the financial systems of the world's most powerful corporations. It's not a crisis visible on the surface, and it's not one the average person even thinks about because, for decades, we were conditioned to believe that large corporations, the giants of industry, technology, retail, manufacturing, transportation, and finance were too sophisticated, too diversified, and too stable to ever face a debt problem large enough to bring them down. Yet here we are in 2025, staring at a mystery few people publicly acknowledge. How did the richest corporations on earth end up sitting on a powder keg of debt so massive, so structurally fragile, that a wave of defaults now looks mathematically inevitable? Behind closed doors, away from press releases and earnings calls, analysts on Wall Street are whispering something terrifying. The corporate bond market is cracking. Not that it could crack if conditions worsen. It is cracking already. And the mystery isn't just why it's happening. It's how the system allowed this debt bomb to grow for decades invisibly and why the world now stands on the edge of a chain reaction that could pull multiple Fortune 500 companies into bankruptcy, reshape industries, and trigger a financial shock the public is completely unprepared for. To understand the corporate debt bomb of 2025, we have to start long before 2025. We have to understand the cost of money itself, because this story isn't actually about corporations, at least not at first. It's about central banks, governments, and global financial structures that changed the rules of the game, from the financial crisis of 2008 until roughly 2022. The world entered an era economists now call the age of free money. Central banks printed trillions of dollars in stimulus. Quantitative easing flooded markets with liquidity. And when money is cheap, borrowing feels harmless. Corporations that previously treated debt with caution suddenly saw it as a strategic weapon. CEOs used it to boost stock prices through buybacks. Boards used it to acquire competitors, expand production, or reinvent business lines. Private equity firms used it to load companies with leverage to amplify returns. Investors bought corporate bonds in record volumes because yields everywhere else were microscopic. Cheap money didn't just encourage borrowing, it rewired incentives. If you were a CEO and you didn't take advantage of low interest rates, shareholders punished you for missing opportunities. If you were a private equity firm, leverage became your business model. If you were an investor, you'd accepted weaker covenants because you didn't want to miss out on yield. And this borrowing didn't happen in isolation. It happened everywhere, across every industry, in every sector. Corporate debt levels soared. Companies that were barely profitable or not profitable at all borrowed billions because the market didn't care about cash flow. It cared about returns, but there was a second, quieter layer. Companies didn't just borrow more debt, they changed the structure of the debt itself. Around 2013, corporations began shifting from traditional fixed-rate debt to instruments that were much riskier. Floating rate loans, private credit arrangements, short-term bonds, and covenant-light leveraged loans replaced the older, safer structures. Investors were so desperate for yield that they accepted terms that would have been unthinkable in the 1990s or early 2000s in previous eras. A company with weak credit would be required to meet strict covenants, minimum cash flow requirements, maximum leverage rate, collateral protections. But by 2016, more than 80% of leveraged loans were covenant-light, meaning corporations had almost no restrictions. They could lose money, weaken financially, or fall behind operationally, and lenders couldn't intervene. It was the financial equivalent of giving someone a loan and telling them, if you can't pay me back later, we'll figure it out. Instead of forcing early restructuring, this system allowed weak companies to roll their debt forward again and again, hiding their fragility. Then came the next turning point. The pandemic. In 2020, global markets froze. Credit markets seized up. Liquidity dried out, but central banks intervened instantly and aggressively, pumping trillions into the system. Corporate bond markets were indirectly guaranteed. Interest rates collapsed back to zero. Investors scrambled for any asset with yield, and in the fog of crisis, corporations borrowed more money than ever before in history. Zombie companies, firms that cannot survive without constant borrowings. By 2022, nearly 1 in 5 U.S. companies fell into zombie status. Corporate debt levels ballooned, maturities shortened, Refinancing cycles accelerated. The entire corporate sector became dependent on the assumption that interest rates would stay low forever. But then the world changed again. And the age of free money ended almost overnight. Interest rates didn't just rise, they skyrocketed. For the first time in 15 years, the cost of borrowing became expensive. This was the spark that finally touched the fuse of the corporate debt bomb. Companies that borrowed HE 2% suddenly faced refinancing at 7%, 9%, or even 12%. Interest expenses doubled or tripled. Businesses that looked healthy under zero-interest policies became unprofitable once money regained its price. But the most dangerous part wasn't the rate hikes, it was the timing. During the free money era, corporations issued trillions in short-term bonds and floating-rate loans. Most of those didn't. They come due in 2023 or even 2024. They come due in 2025 through 2028. This is the maturity. While the cliffs of debt, corporations must refinance at dramatically higher rates, whether they can afford it or not. And here lies the core crisis. Many companies simply cannot afford to refinance. The math doesn't work. If a corporation was paying $200 million per year in interest and the refinancing pushes that to $600 or $700 million, something has to give: layoffs, asset sales, restructuring, or outright bankruptcy. This is why defaults are rising. Quietly at first, but accelerating. Once a few companies default, lenders tighten standards. Credit dries up, spreads widen. A domino effect unfolds. On this chimney, unlike 2008, the first cracks aren't forming in the banks, they're forming in corporations themselves. When corporations begin defaulting, the fallout spreads everywhere. Pension funds and insurance companies, big holders of corporate bonds, take losses. Private equity firms see their leveraged acquisitions unravel. Banks absorb loan losses and respond by tightening credit across the economy. Companies cut jobs to save cash, pushing unemployment higher. Markets react with panic as bond spreads widen and volatility rises. Entire industries slow down simultaneously. The effects ripple into every corner of the economy, creating a loop of tightening liquidity, reduced spending, falling profits, and more defaults. Governments and central banks have tools, but in 2025, those tools are far weaker than before. They can't cut rates without reigniting inflation. They can't print unlimited money without destabilizing bond markets. They can't bail out every corporation because the debt burden is too massive. They can't save zombie companies because their business models don't work with higher rates. Private credit can't rescue the system because private lenders are themselves stretched thin. The world has reached a point where there are no clean solutions, only painful ones. The system must deflate through defaults and restructurings. What makes this even more alarming is that we've seen this pattern before. Japan in the 1990s, telecom companies in the early 2000s, each time the same signals appeared. Rapid debt growth, artificially low interest rates, weak covenants, reliance on refinancing, and sudden rate shocks. The corporate debt bomb of 2025 is just the largest version of a very old story. But this chimney, the scale is unprecedented. The leverage is global. The fragility is systemic, and the pressure is concentrated in multiple sectors at once. Because corporate debt doesn't show up on the surface. It's hidden in footnotes, balance sheets, and bond maturities, not headlines. Consumers focus on prices, wages, and jobs, not interest. Coverage rate. Politicians focus on inflation and GDP, not corporate liquidity. Most barely want to realize how dangerous the situation is until a major household name corporation suddenly declares bankruptcy. And by then, the dominoes will already be falling. The crucial question is what happens when hundreds of billions of dollars of corporate debt need to be refinanced at much higher rates, but companies don't have the cash flow to support the new payments. In 2025, we are entering the phase of the crisis where the debt bomb detonates in slow motion. Some will shock the public because the companies involved seem too large or too essential to fail. But once the defaults begin, the system tightens and accelerates the crisis. Lenders become cautious. Refinancing becomes impossible. Private credit freezes. Markets panic. Bankruptcies surge. There are three essential takeaways. First, the crisis is structural, not temporary. It is the direct result of 15 years of ultra-cheap money creating fragile corporate balance sheets. Second, the maturity wall is unavoidable. Companies cannot postpone refinancing forever. The deadlines are approaching, and they will force action whether the market is ready or not. Third, Defaults are not a risk, they are an inevitability. The math no longer works for many corporations. Their business models cannot survive higher borrowing costs. The corporate debt bomb is not a theoretical crisis. It is happening. Quietly, silently, one company at a time. It will be because a familiar, well-known corporation suddenly collapses. People will ask, how did no one see this coming? But now you do. If you found this breakdown valuable and want more deep dive economic investigations like this, make sure to like, subscribe, and turn on notifications so you never miss an update. And tell me in the comments which sector you believe will face the default wave first, retail, manufacturing, real estate, or something else entirely.